In Southeast Asia, there's a lesson about territory that nature teaches far better than any economics textbook. The saltwater crocodile doesn't hunt like other predators. It doesn't chase. It doesn't compete for space in the food chain. Instead, it does something far more strategic. It controls the river. You see, the crocodile positions itself at the choke point where the fresh water meets the salt, where prey must pass to survive. And then it just waits, patient and movable, while other predators exhaust themselves hunting across vast territories. The crocodile simply owns the crossing. And once it controls that crossing, everything else in the ecosystem has to adapt around it. Now, over the last decade, Indonesia has become a crocodile. But the river that it controls isn't water, it's nickel, that metal that powers the batteries in your electric vehicle, in your smartphone, that stores energy from solar panels, that sits at the heart of the global energy transition. And just like the crocodile at that river crossing, Indonesia doesn't just participate in the nickel market, it is the market. The numbers don't lie. Let's start with scale. In 2017, Indonesia produced 16% of the world's nickel. A meaningful share, absolutely, but nothing close to dominance. If you fast forward to 2024, that number has exploded to 62% of the world's refined nickel market. And when you factor in China's processing capacity, which refines most of Indonesia's raw nickel output, the Indonesia-China axis controls 75% of global finished nickel production. Now let me repeat that, 75%. For a bit of perspective, OPEC, at the height of its power, controlled 55% of the oil market in 1973. But even that was enough to send global oil markets into a tailspin at will. What's so remarkable is that this was not a gradual shift. It was a quick takeover. Now, the crocodile doesn't just control the river anymore, it owns it. So how did Indonesia seize this vital choke point? Indonesia's dominance did not happen by accident. It was incredibly specifically engineered. You see, in 2020, the Indonesian government implemented a nickel ore export ban. Now, a policy that looked simple on paper, but it was devastatingly effective in practice. And here's how it worked. Moving forward, if you wanted access to Indonesia's nickel reserves, which happened to be the richest on the planet, you couldn't just buy the nickel off the market anymore, export it to your country and refine it there. Moving forward, if you wanted the nickel, you had to build processing factories in Indonesia. You had to refine it in Indonesia. You had to create jobs, transfer technology, and leave value, i.e. margin, behind in Indonesia. They didn't just increase supply, they restructured the entire value chain around themselves. And the results speak for themselves. Nickel has now surpassed coal as Indonesia's top export commodity, hitting $16.5 billion in the first half of 2025 compared to coal's $14 billion. For the first time in the country's modern history, nickel sits at the top of the export hierarchy. The choke point is secure. Now let's look at the dragon in the story, China's $65 billion bet on Indonesian nickel. And here's where the real leverage comes into play. Indonesia could not have pulled this off alone. Over the past decade, Chinese companies have poured roughly $65 billion into Indonesian nickel processing facilities. China, therefore, secured access to the raw materials it needs for its battery and its EV ambitions, while Indonesia captures more value through downstream processing. It's a symbiotic relationship and a very formidable one. Indonesian nickel production benefits from structural advantages that Western producers simply can't match. Their low-cost energy, their low-cost labor, economies of scale, and because of China's capital and state-of-the-art processing, China gets to put their fingers on the scale anytime they want. And what's the result? Indonesia and China have built a nickel production machine that operates at a cost structure that Western miners cannot compete with. And that's where the carnage begins. So let's have a look at the body count as a result of this policy and how oversupply has killed the competition. When Indonesia flooded the market with cheap nickel, high-cost producers in Australia and Canada didn't just stumble, they outright collapsed. Let's start with the biggest casualty, BHP's Nickel West operations in Western Australia. In October 2024, BHP announced the temporary suspension of its entire Western Australia nickel division, the largest nickel operation in the country. And this wasn't a minor pullback. This was a full shutdown. They shut down the refinery. They shut down the smelter. They shut down the Mount Keith and Leinster mines, plus the $1.7 billion West Musgrave development project. Over 3,000 people lost their jobs. The division posted a $300 million EBITDA loss with negative cash flow every year since 2020. BHP wrote down $3.8 billion in impairments, and the executives were blunt. They stated, like others in the Australian nickel sector, we have not been able to overcome the substantial economic challenges driven by a global oversupply of nickel. So what's the translation? We can't compete with Indonesia. And BHP is far from alone. First Quantum's Ravensthorpe mine in Australia permanently closed in May 2024. 330 jobs just gone. Glencore's Koniambo Nickel in New Caledonia permanently shut down. Glencore invested over $9 billion since its inception without ever turning a profit. In Canada, major mines in Sudbury reached end of life and transitioned to care and maintenance. The Caribou mine in New Brunswick fell into insolvency. Industry analysts are now tracking 77 nickel projects on hold due to poor market conditions. Canada and Australia account for the most suspended projects, and the pattern is clear. Indonesia's oversupply didn't just lower prices, it rendered entire operations economically unviable. The crocodile didn't need to attack, it just needed to sit at the crossing and wait. So what happens next? Survival for Western nickel producers means carving out a specialty lane because the volume game belongs to Indonesia. The crocodile controls the river, so if you want to survive, you've got to find another way to cross. The options are diplomacy or innovation. Now let's focus on innovation because there is a brand new wild card in the mix. Let me explain. While Indonesia controls the land-based nickel supply, a new frontier is emerging, one that doesn't involve digging into mountains or clearing away forests. It involves harvesting metal from the ocean floor. Deep-sea mining focuses on polymetallic nodules. These are potato-sized rocks sitting on the seabed of the Pacific Ocean. Now, these nodules contain high grades of nickel, copper, cobalt, and manganese in concentrations far higher than most land-based ores. And industry estimates suggest that battery-grade nickel from ocean nodules could land in the lowest cost quartile globally once full production is achieved. The advantages are compelling. Higher ore grades than most new land-based mines, meaning less waste per unit of metal, multi-metal deposits providing natural diversification, and lower infrastructure costs because you don't need roads, you don't need ports, and you don't need permanent facilities. No deforestation, no community displacement. And while mining in the ocean absolutely carries risk, one quick look at the devastation to the Indonesian rainforest will give you some very important perspective. Because unless we all agree to just shut off the lights, we are going to need the nickel from somewhere. Now, on paper, deep-sea mining looks like a game changer, a way to bypass the crocodile entirely. But there are a few problems. 3 to be specific. Deep-sea mining faces obstacles that could kill it before it starts. The first one is regulatory uncertainty. The international regulatory framework for deep-sea mining is incomplete at best. No commercial mining permits have been issued in international waters. Multiple countries and environmental groups oppose commercial operations altogether. And in those international waters, nobody knows who makes the rules, and therefore nobody knows who should enforce them. And until that is settled, deep-sea mining is stuck. Obstacle number 2, environmental opposition. The deep-sea ecosystem is very poorly misunderstood, and scientists warn that mining could disrupt carbon sequestration systems. This could create sediment plumes affecting marine life across vast areas. It could cause irreversible damage to habitats that took millions of years to develop. Multiple environmental groups and several countries have called for an absolute moratorium on deep-sea mining until these impacts are better understood. Now, this opposition creates significant regulatory and public relations challenges. And the third barrier is technical and economic risks. Operating in extreme deep water conditions is hard. Scaling up from pilot tests to commercial operations is even harder. Processing nodules economically at commercial scale, it's completely unproven. And the total cost of ecosystem restoration has been estimated at millions of dollars per square kilometer, which could blow up project economics entirely. Deep-sea mining companies face competition from continued cheap Indonesian production expansion. With current nickel oversupply projected to continue through the late 2020s, the economic rationale for expensive deep-sea mining experiments might be weakened. Operators will need to ask, why should I take on massive technical and regulatory risk to mine the ocean floor when Indonesia is already flooding the market? But there's a very important question that I want to ask now, and this is deep-sea mining better or worse for the planet than land-based mining? Now, recent research has revealed that the environmental impacts of nickel mining has been severely underestimated, and I'm talking about on land. Now, I live in Indonesia part of the year. I've seen it. The Indonesian nickel industry is arguably the worst environmental disaster of my lifetime, and one that absolutely nobody is talking about. The Indonesian rainforests are among the most biodiverse ecosystems on Earth, home to thousands of endemic species like orangutans and Sumatran tigers found nowhere else on the planet. And these ancient forests blanket volcanic islands, creating vital carbon sinks and supporting incredibly complex webs of life. Poorly managed mining projects completely remove entire ecosystems. I'm talking about trees, soil, and biodiversity, while contaminating water and soil, releasing massive carbon emissions and eliminating the forest's carbon absorption capacity. Deep-sea mining proponents argue that their approach offers advantages. There's no deforestation. There's no displacement of communities. There's orders of magnitude less living biomass disturbed and significantly lower carbon emissions. At the end of the day, neither option is clean. But let's get back to the river. Where does this leave us? Indonesia has seized control of the nickel choke point, and it's not letting go. The combination of strategic policy, Chinese investment, and structural cost advantages has created a supply machine that Western producers can't match on either volume or price. The crocodile metaphor wasn't just a colorful opening. It's actually the entire story. Indonesia didn't stumble into dominance, it engineered it. It identified the choke point, locked it down with policy, brought in Chinese capital to build processing capacity at scale, and then flooded the market until high-cost competitors drowned. BHP, First Quantum, Glencore, billions in write-downs, thousands of jobs gone. Not because they were poorly managed, but because they couldn't compete with a cost structure built on $65 billion of Chinese investment, low-cost energy, and low-cost labor. Not to mention the environmental concessions. Deep-sea mining is the dream of another river, a way to bypass the crocodile altogether. But dreams need permits, they need public acceptance, and proven economics at commercial scale. Right now, it has none of those. And with nickel markets oversupplied through the 2020s, there's no market pressure forcing investors to take the risk. So the crocodile can just sit at the crossing. And here's what that means for the energy transition everybody keeps talking about. Look, we want to go green. We want electric vehicles and solar panels and batteries that store clean energy, but we handed the keys to that energy transition to a single choke point. Therefore, one policy change, one export restriction, one geopolitical shift, and the entire energy transition grinds to a halt. That's not resilience, that's vulnerability wrapped in a sustainability narrative. Years ago, the West wanted to move away from oil dependence in the Middle East, and so we built sustainable production at home. But we traded that for battery dependence in Asia. And the question isn't whether or not Indonesia will maintain its dominance in the nickel market. The question is, what happens when that crocodile decides to close its jaws. This is the consequence of globalization, the system that we all voted for. We wanted to outsource many parts of the supply chain to countries far away, but as a consequence, we are dependent on their decisions. Those are the vulnerabilities of the system we created. Now, what's the path forward here? It's either diplomacy or it's innovation. We're going to have to wait and see which path we take as a nation, but I guarantee you it's going to be an interesting ride. I cover these stories every single week right here on The Jay Martin Show. If you enjoy my content, hit that like button, click subscribe, but most importantly, share this video with a friend. That's all for today. I'll see you next week.